This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
To another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Brian Payne, Chief Strategist with BCA Research. And we're going to be kind of taking a very analytical approach to the coming months, quarters, and maybe into next year of kind of what's going on in commercial real estate and how some of the fundamentals of the markets that we've been so used to over the past 2, 3, 5 years are really kind of shifting, and what that's going to mean for the investors, the syndicators, the sponsors, and really kind of what you're going to need to know to best position yourselves to be able to protect yourselves on the downside, but also hopefully be able to take advantage of some of the opportunities that are going to arise. As with anything, whenever there is some type of paradoxical shift in a market, it is going to affect some people negatively, but where there is a downturn, there's also going to be a commensurate opportunity. So Brian, thank you very much for being on with us today. I'm very excited to kind of dig into this. I really like the analytical approach to things, and dealing with strategists and analysts is always fun. So if you wouldn't mind, give us a little bit of background about yourself and kind of how you came into the current position you're in, and then we'll dive into the topic at hand.
Yeah, absolutely. Pleasure being with you, Alex. So just real quick on my background, how I kind of got to BCA. Maybe a bit more unusual for kind of the path to be a strategist, but I started my career on the wealth management side, working for a consulting firm with the end client being high net worth, ultra high net worth. We'd work with the RIAs, different type of client base relative to some of the institutions we work with, really trying to figure out how to access private markets and alternatives and then fit them in a portfolio with the end client being high net worth, ultra high net worth. So a lot of competing demands there. I then transitioned to the buyer side, where I was working for a hedge fund in Washington, D.C., doing trading, risk management, strategy research, a little bit shorter term in that type of wrapper, but very helpful when I did come back out to the allocator side, when I moved to the pension fund side of things to pick managers, direct investments, etc., within a fairly unique portfolio for a large U.S. Public pension. I was managing a multi-billion-dollar portfolio that made up pretty much everything we do cover with private markets and alternatives at BCA. So looking at hedge funds, private equity, private credit, real estate, and various forms and vehicles, and also spend a lot of time at the asset allocation level when you're bringing all of these very disparate asset classes in to determine what should our mix be, how should we be allocating, how should we be navigating the up and coming market cycle. And that's really all culminated with what we do at BCA. So I've spent my entire career in the alts arena, and that's what we do with BCA, and a more forward-looking type of service than anything you really see out there.
Yeah, absolutely. And that's, again, kind of why I like talking to people like you, is that, I've based my entire career in the alt space. It's kind of, not too many people can kind of have that trajectory, but it's always good when I talk to people that, have a healthy understanding of these kind of markets and what they do, and as far as, what asset allocations look like, and, how that plays into market conditions as well. So kind of, we talked about some of the bullet points that we wanted to discuss, and we'll just kind of start with the high topic of, multifamily supply and what that looks like in relationship to vacancy rates that might be continuing into the next year. I know we're seeing, starting to see the culmination of the underwriting of some of these deals over the past 3 or 4 years kind of come to fruition, and with the cap table compressions and people starting to really feel the squeeze of needing to either get really expensive bridge debt or starting to liquidate out some of these assets, supply is starting to really ramp up. So maybe if you kind of talk a little bit about, the specifics of, why we're seeing what we're seeing and how that's going to affect, kind of these markets going forward.
Yeah, absolutely. Supply, supply you can slice and dice in a number of ways when we look at absolute levels of, multifamily apartments under construction and looking at kind of 5 units or more. So those larger structures out there that are institutionally owned, we haven't seen these levels really since the early 1970s. Actually, they've exceeded the 1970s. When you look at it relative to single-family housing, only the early 1970s exceeds it. So supply, when you look at it from those terms, look quite elevated. We also slice and dice it when looking at not just construction, but completions and those online. We normalize for population growth, that is. And it still looks quite elevated relative to all the periods we just discussed. So when you think about it on a going forward basis, supply is just one element to the equation. I'm sure we'll talk about demand shortly, but the supply side of things is really accelerated, really post 2020 and then through 2022, especially as most folks did notice the ability to pass through rent, how the inflation, how it has realized as a nice inflation hedge because you can pass through rent. So you're seeing more and more building there. Ultimately, with the end goal being, hey, we think this demand is going to meet that. We do have concerns around that demand. So when you do look at supply again, it does look quite elevated. Completions look elevated. Under construction are quite elevated. They are starting to roll over and look a little bit better, but we are coming off of pretty unprecedented levels.
Yeah, so, as far as kind of where you see the main drivers of supply coming in, do you think it's necessarily going to be the completions coming to fruition, or do you think it's going to be operators trying to then in turn offload the assets that maybe weren't underwritten as well as they should have been, when we basically were in a market of almost free money, which again, I was always kind of looking at this from the perspective of seeing all of these deal decks come through and just looking at kind of the assumptive nature of the market saying, it's like, okay, well, we can refi at 4 years or after we've captured all of our depreciation. I'm just looking at it like you're making a wild assumption that these, almost unprecedented cheapness of money is going to be maintained. So, where do you kind of see the biggest drivers of supply coming in? Like, what are some of the factors that are going to really push that into the next year?
Yeah, I think you hit on a couple of them, maybe a bit more of kind of the latter, but I think the impetus for why this has really changed, kind of that catalyst, it really comes back to interest rates. Interest rates are the fundamental input to any financial model out there. The cost of capital, it's what we spend the majority of our time thinking about. And when you look at the dynamics between growth, inflation, unemployment being an indicator of growth, that's really what we're looking at, where interest rates going to go when you go from less than 1% to now above 5%, and then you put your spread and financing on top of that, particularly with multifamily, where you're looking at situations where folks just can't pay the bills off, and the NOI growth or the rent growth, all that cash flow that's coming in has gotten to a point where folks just can't pay for the debt anymore, especially with the increase in interest rates, and a lot of these are floating rate structures overall. So a lot of these will go back to the lenders, but the lenders don't want to take the keys back. That's not what they're in the business for. So, as always with commercial real estate in general, it's going to take a number of years for this kind of rebalance to ensue. We are starting to see the beginning of it, but it will take a number of years. And those that have been holding these assets, even those that were underwritten in a little bit different environments, well, they're going to take markdowns as well, and it's going to hit those folks too. So in general, it's just going to be kind of a slow grind to kind of get out of this, but with a lot of folks, a lot of the lenders taking the keys back, and we just wouldn't be surprised to see it, and we're starting to see it, that you just don't see a lot of these apartment buildings get completed, especially right now when construction loans are even higher than kind of operating loans in general, that we just wouldn't be surprised to see a lot of these apartments just kind of sit there, go idle, and that does have ramifications on an economy where you think about all the service providers, construction maintenance operators, et cetera, that go into maintaining these buildings. Well, those are folks that are also going to get dinged as well. So we do think there are economic implications, albeit not to the same degree as GFC levels.
Yeah, and I think it's one of the things you kind of hit on right there is that, lenders, especially in the commercial real estate space, they're not in the business of taking back these properties. And you would like to think that commercial financial institutions learn some lessons from 6, 7, and 8, but, taking in a huge role of REOs, I mean, in single family, they saw the drag on just the markets, that the amount of human capital it took to actually get that stuff back out into the market and recoup some of that is going to be greatly exacerbated by trying to do it with multiple multi-million dollar properties and assets. So it kind of would lead to believe okay, they're going to take some back. They're going to get to a point with some of these properties, if they're going to be so underwater the operators can't get any type of debt that's going to make sense for the continuation of their operation. But I would imagine, and maybe kind of if you can speak to this, the willingness to try to come to the table a little bit more with some of these operators and do renegotiations or extensions, as opposed to starting litigation with these people. Because when you talk about foreclosing a $300,000 single family home, that is a whole different aspect than foreclosing a $50 million apartment complex. So just the legal capital as well as the human capital involved in that has got to be enormous. So maybe kind of some of your thoughts on, when the squeeze is coming, and it certainly is, what at least the commercial financial side of things is looking to do with that.
Well, I think you kind of touched on that. I think there is a lot of incentive for the lenders to kind of amend and extend. We've seen a lot of that. You've seen a lot of the ones that were supposed to mature in 2023 get pushed to 2024, and it seems to keep building. At a certain point, folks just can't amend and extend. But overall, we are quite positive on lending in the space from this day forward, really the past kind of year, going back 1 year to now. Lending in general, because we think you'll get paid very well on that capital. It's very starved of capital, and there is a very strong desire from these borrowers, particularly the ones that aren't the tourist leg, to stay in the game and get that capital and be able to kind of continue forward. Now those that did the lending really kind of those more lofty times, particularly 2020, 2021, when interest rates went down quite a bit, those lenders, some of those loans are definitely going to go bust, and they're not going to be able to kind of recoup some of them. But in general, we think that that's a bit more behind us. Everyone understands the financing backdrop going forward. That we think you can get some pretty healthy returns of lending capital. Now, as it relates to the equity owners of it, going down past the debt holders into that residual, again, the equity owner, that's where we think a lot of that pain will be felt. But the debt and lenders right now, because of how starved the place is, starved the sector is of capital, and the fact that we're still in fairly restrictive financing backdrop, even if you do fast forward from 2022, that we think you can get a nice premium on that overall. Now, in terms of how some of these folks and borrowers, well, I'll just leave it at that. I don't need to extend that more.
Yeah, for sure. One thing I did want to touch on before I kind of get into the trajectory of the current like capital deployment space would be one of the points that you kind of had bulleted in there on was for vacancy rates to maybe continue to increase. But at least from my perspective, I would think if we're going to, and again, it's not if, it's when, we're going to be seeing some type of economic, again, I use the recession and just the general word of just, receding, from the levels that we've had. It's going to correct to a certain point. Whether that actually gets to the qualified recession level with the GDP markers, no one knows that. But again, it's going to recede to a point. Now, at least with, looking at the purchasing of single family homes when it comes to either first time home buyers or individuals moving and trading those for primary residencies, again, I think we'll definitely see that slow down. But when that slows down, people are going to need a place to live. So the propensity for the rental market of at least apartments would seem to be still relatively strong in that use case. So at least from your perspective, why would you think that vacancies might either increase along with this? What would be kind of some of the reasoning behind that?
So near term, we do see the ability for that the demand to kind of still be there, preventing vacancy rates from jumping. Now we're also seeing development, and that's mainly because of the single family housing situation. If you taking a step back, if you think about kind of post 2020, who are the two largest demographics of the population? They're millennials and then Gen Z. Now, millennials used to live in apartments, 3-4 folks in an apartment. Now they're a bit more financially secure, and then they, after COVID, was able to get apartments for themselves. So household formation increased for that cohort, but now that cohort is moving into kind of their early 30s, mid 30s, getting married, having kids, and that typically lends itself to wanting single family homes. And we do see that demand extremely strong, and it's been the same strength as it's been the past few decades. The idea of owning a home in the U.S. or just in general, the American dream is still very much alive. So you've had that demand that's always been there for apartments. We think that recedes, but if single family housing doesn't get alleviated, well, they're going to continue to demand apartments. Now, we are starting to see the signs that single-family inventory is starting to build up. We're seeing across a number of regions, so we think that might come. We think that the supply, that demand might recede a little bit quicker. I'll get to the recessionary part. The Gen Z, similar situation. Now, when they went through COVID, they never went to apartments and living with 3-4 folks in apartments. They had the ability, given the fiscal stimulus that occurred, to move into an apartment by themselves. So household formation got brought forward for them. They're also in the boat of the millennials that deal with the GFC that the millennials dealt with. So they're in a maybe feel a bit more financially secure that they also want a single family home. Now, the issue again is single family housing supply is extremely low. but we are starting to see the beginnings of that pick up, especially with the recessionary signals. And you do have the recession, depending on how deep or shallow or how shallow or long it is, will definitely portend to that demand going forward. But you do have that issue. Single family inventory picks up. You are going to see that demand come forward for single family and away from multifamily a lot sooner than others. And we are seeing occupancy rates, if you just take the inverse of vacancy rates, they have come down from the highs. They're actually by the averages at the moment, about 93%. But we expect them to go through that, especially with the recession, and that will continue to kind of push on rent growth, NOI, and the prices overall for these kind of multifamily residencies. But it is quite an interesting kind of push-pull with when you look at single-family housing and you look at a recession, when you are trying to define demand over the kind of coming years. And we do look out 5+ years, but we are starting to see that demand recede a little bit earlier than we expected, again, because we did not expect to see single-family inventory pick up, and we are seeing that in a number of regions.
Yeah, and I would also imagine too, at least with the newer development construction coming online, when you have, it's you buy an existing building and you have a certain occupancy rate. You have zero occupancy once you finish the property, and you have to, tool that up. So, depending on how many of these actually come online, that's going to be, again, just an influx of empty doors that have to be filled. So do you think that would necessarily be something that's not would that be something that would have a measurable effect, or is that kind of accounted for, or at least when you're looking at what you're looking, or do you think that's going to come online and then, plugging in a bunch of zeros into that mean average is going to drop it down some?
We can measure that, and a lot of the more real estate, the more specific real estate, I guess more granular real estate providers that look at across cities, regions, et cetera, try to extrapolate that kind of that demand, that population growth out and determining what kind of vacancy rates there are. But again, I think it's just an underestimation of where that demand is going, particularly from millennials and Gen Z, that over the past kind of 5-10 years or so, that demand has been quite strong, even as more have come online. So that construction was anticipating that demand staying there, and also not anticipating the rise in interest rates. Interest rates have risen, for one, and then secondly, we do believe, and we think we're a bit more out of consensus, that demand is not going into multifamily, and it's going away from that. And those we don't think are accounted for, or at least are starting to be accounted for, because you have seen construction kind of come to a halt, not accounted for into those forecasts, particularly when those folks are looking at occupancy and vacancy rates going forward.
Yeah, no, absolutely. So to transition a little bit into kind of the market that we're currently in, compensating for risk, I'm assuming, is probably like a kind of a core focus of what you look at. Now, you mentioned that you're going to see some positivity in the markets when it comes to actually the monetary side of things. So being on the lending side of things and actually being the debt originator for some of these things is going to become more attractive. Now, I would like to kind of get into that because I've talked to a few different people about this, and my own thoughts notwithstanding, it just seems to me that if the money is so expensive on the institutional side, how do you make your dollar? How do you make it? How do you underwrite these things to make it make sense from the lending side of things for it to kind of play into what you said on some positivity in that market?
Interest rates go down, so most folks have not. The majority of market participants have not experienced inflation or rise in interest rates. You have to go back to the 1980s to see anything kind of close to that, and obviously it's a little bit different environment than it is today. So when you model it out, most folks, you've seen this in the private equity space as well, but their flexibility is definitely a little bit better than the real estate side of things for a variety of reasons. But when you do the modeling, you've pinned interest rates coming up to where they are, 5+%, and then they're going to come down. And, if you rewind to earlier this year, we were expecting more rate cuts. Now we're not expecting rate cuts, maybe one. So that continues to kind of push on that. But if you do get the recession, and we think of recession because we are in, this is American capitalism. That's part of the economics of American capitalism. You do get boom bust. You just hope they're a little bit more tamed and aren't as egregious. You do get a recession, you will have interest rates come down, but not to the same degree as they did before. That will alleviate a lot of things, particularly when it relates to multifamily. But near term, 50 basis points lower in interest rate, if the Fed comes in and lowers by 50 basis points, that's not going to do a lot. It needs to come down by 100+ basis points at the very least, and we think that only happens with a recession. So that could be a more positive situation to get more along these assets. But again, the supply demand still is kind of pushing against that we just see better opportunities elsewhere, not even just in CRE, but outside CRE and some of the other alternative asset classes we kind of touched on.
Yeah, no, and I think that's kind of a good transition because, so much at least of, what I do professionally is that whole spectrum of anything alternative, basically if it's not a publicly traded stock fund or mutual fund, that's, what I've kind of carved out my niche in. So, I think again, we've kind of covered the commercial real estate space, pretty well of just, there's a lot of, and the funny thing is that as much granular detail as we've gotten, there's still a big question mark, right? It's, if the recession, how much recessionary factors come in is going to determine, how much of a rate cut we're going to see. We need this, we might expect that. It's kind of, again, a little bit of a waiting game to see how this stuff kind of plays out. But I think the core thing to take away from, what we've been talking about right here for our listeners is that, watch it carefully. And if you're invested in it, make sure you understand, what your operators are doing to try to mitigate that stuff. If you're looking to get into it, really understand and maybe, invest with people that have, gone through, maybe just not the past 3 or 4 years of operating these things, operators that maybe have 10, 15 years of experience under their belt to kind of have, gone through some similar situations. Granted, every economic situation is going to be different when it comes to, bull bear markets. But again, it's going to be interesting to watch and see just how, again, that dichotomy of the pushing and pulling between the Gen Z millennials wanting to get into the single family homes versus the occupancy that's going to be coming in commercial multifamily. Again, I'm very curious to see how it's actually going to play out. But to your point of, what this compression of the commercial real estate space looks like, it expands into other things that might have a more attractive option when it comes to other alternative assets. So what kind of other markets in the alternative space are, you kind of excited about or kind of have some interesting things going on that would be good for, our listeners to kind of maybe take a stronger examination of?
Yeah, actually, maybe I'll just stay in the CRE space, and then we can kind of branch out. Even more specific to the multifamily side, we do speak more to the private angle, but we are fairly cognizant of what's going on in public markets, particularly public REITs. Seen a lot of retracement there, and some of those cap rates are in the kind of 6.7s, depending on some of the REITs you look at. And that's really kind of within the range of where we're expecting these cap rates to peak at, and we're looking at kind of 4s to 5s right now. So expecting on the private side to go up, but within the public space, they are looking a bit more attractive now. It is fair warning to listeners that public REITs do act a little bit differently than privates, and you can see that. You go back to years like 2022, public REITs got hit very, very hard in the beginning of 2022 when inflation was going up. Privates did the opposite, so just a fair warning on that. But the public REIT side is starting to look a lot better, especially where prices have gone, especially because those are incorporating sentiment. Now, within CRE and the private space, even further, we talk about office. Office is always a hot topic. We are now overweight office. We're not pounding the table on office, but we are overweight. The reason we're not pounding the table is you need another 2, 3, 4 years for the cash flows to be positive again, the supply-demand balance to get back into check. Kind of similar to what happened in retail in the kind of mid-2010s with malls. It's going to take a while for those to kind of rebalance. But when you're looking at the entry point on the price side with office, you're looking at huge 50, 60, 70% discounts. So your margin of safety is fairly well built in. And if you're looking 10, 20 years out, and we do these assumptions for clients, that's starting to look pretty interesting, high single, low double digits with a really good, attractive diversification profile. Again, you go back to the year like 2022, one of the best performing assets out there because of the inflation hedge or the inflation premium built into it. So on the office side, we're getting more excited. We're seeing cap rates even surprise us. They're already in double digits. They're seeing very business-friendly towns, kind of 10, 11, 12%. That's a very attractive, very good starting point. And yes, we can debate urban economics ad nauseum, but people will go back to these cities. You see that in New York, you see it in other towns. A lot of these are core-focused properties, so they don't need a lot of maintenance to be put in. That buying these buildings look pretty interesting right now, but again, not pounding the table. Industrial side of things, it did look a little egregious given where cap rates have gone, given appreciation, but construction has fallen off quite precipitously, surprised us a little bit. That might be a very good entry point there if you do get a recession coming up as well. So those are interesting. And then the retail side, which everyone has hated retail for many years for very good reasons, but they've had the ability to really rebalance going through COVID and really incorporating e-commerce a lot more effectively than the other sectors. So when you're looking at cap rates there, which is one measure we do look at amongst many, that's actually looking more attractive than most people would realize. You do get a recession, you could get a good entry point. But so far, they've actually performed a lot better than all the other sectors we laid out. So we are getting very positive on CRE, even though we see more issues in the pipeline, especially near term. But we want to start being buyers there. So we are moving that way. Outside of CRE, just to kind of top it off, I think still attractive opportunities within senior direct lending of private credit. We know a lot of capital has gone in there, but a lot of capital has gone into buyout, especially middle market buyout, both North America, Europe. And those typically tend to be the borrowers of senior direct lending. So we think those are still in a very good spot and getting some pretty healthy returns, even if interest rates do come down. Distress is one of the best opportunities out there when we look across the three elements of the top down being the macro yield curves, tight financing backdrop. It gives us a green light. The bottom up is starting to pick up with defaults, particularly in leverage loans, and now high yield picking up, depending on what measures you're looking at. So that's a very good, that's a green light from a bottom up standpoint. And then lastly, no one's expecting a default cycle. No one's expecting recession. So the capital going into these vintages or evergreen structures, we think is not competing with a lot of other capital out there, and really will yield some pretty interesting returns kind of over the next market cycle. And then outside of that, we think venture capital within the private equity space that's had a nice reset, has less debt financing, more equity financing, the ability to weather some of the growth headwinds we do see near term and realize those multiples 5, 10 years out. Even some of the early stage AI, there's going to be winners and losers. I know that's not the most novel statement, but those folks that can kind of sidestep that or look at how they go through the late stage pipeline, we think that capital will receive a nice premium. And then lastly, in hedge funds, just to kind of round it out, we're quite contrarian there. We're actually quite positive directional strategies, long short equity event driven. We were looking at this yesterday since 2023. So you go 2023 to the first 6 months of 2024. So 6 quarterly data points. Directional hedge funds, long short equity hedge funds have outperformed every asset class we cover. Very liquid, and you're in a very good position as an LP to negotiate fees, which is your alpha. So even though we do see challenges on the equity side of things, we think the alpha looks good within long short equity, as well as the ability to generate higher absolute returns over a market cycle because the ability on the short side of things, which looks a lot better with the meme stocks a little bit more behind us and in front of us. So those will be some more positive. We're real positive across the alts landscape.
Yeah, no, I mean, there's a lot of great things to dig into. A few things I wanted to kind of carve out. Again, getting back to the CRE space a little bit, and then I took some notes on a few other things I want to extrapolate on. But again, it's, talking to anyone about the office space is always interesting, and especially, getting anyone's opinion about what it's doing. I think you're probably the first person I've talked to that's been anything but completely bearish on it. To hear someone say that there's a marketable strategy to actually entering into this stuff now because of the discounts that you can actually kind of attain in this space is interesting. And I like to kind of cover that a little bit from your perspective because a few things that I've talked to, at least when I talk to the the operators and the developer side, is their big concern is that, okay, we just don't have as much occupancy, especially in the larger space. So what do we do? Because these buildings can't necessarily be easily repositioned into anything other than office. You can't just make an apartment building out of an office because there's no plumbing, there's not the electrical, there's not the infrastructure built in to do a kind of a like to like conversion to another asset class. They're kind of purpose built for what they are, and that's office space. So, although it's great to say, hey, you can get these things for kind of, pennies or half pennies on the dollar of what you're looking at as compared to what they might have been trading for, pre-COVID, what is kind of the thought process and what is the operational structure that you're looking at for these? Is it just that, like you said, people, or these are operating in more business friendly environments when it comes to governmental regulation, or is it just more people coming back to the office? What are some things driving kind of your not necessarily a hard red light and stop sign on the office space?
Yeah, so like I said, we think the prices have declined to be very attractive when you look at the margin of safety. But I'll just reiterate, the next few years, you're not going to get a lot of positive cash flow out of it as things need to rebalance. You made a very good point, and something we do highlight within our research, the ability to convert within to multifamily, even hotels, even warehouses. Well, that's not that cost friendly because it's usually less than 1% get converted because of the cost regulations, et cetera. To do such, making sure it's well, I don't need to touch on that anymore. You hit that pretty good there. So it usually isn't the easiest thing to convert. Now, where you have to where there could be kind of such instances, maybe government regulation that gives the incentive to convert those, lowering taxes, et cetera, and make it a little bit more palatable. That would be maybe you do convert to more multifamily. Hotels are actually at quite a lack of supply right now following COVID. So we're actually quite positive on hotels, but even converting to hotels would be a challenge. But if you can put some incentives there, government taxes, et cetera, then maybe that can accelerate some things and then eat up some of that excess supply. Now, as it relates outside of that, and we do think, I'll give you a perfect example, BCA ourselves. Now I'm based in Washington, D.C. A lot of our strategists are kind of based all over the world, but the main office is up in Montreal. Years ago, before COVID, BCA had 2 floors in an office building across the street. Following COVID, we moved office buildings and we took up now half a floor in the other office building. We renewed that lease last year. The other side of that office or that floor is vacant. Now, what we said is there still is demand for office. People are going back into the office. Maybe you get a recession and you get to accelerate it more because unemployment go up and the companies would have a bit more negotiating edge in terms of saying you got to get back in the office. So that can zap up some of that supply. But you just need a fraction of the footprint you did before. You still do want an office out there. So it's just going to take time for that supply to kind of get zapped up. And again, it's just going to take a while for that supply and that demand to meet that supply. But we do expect that demand to be there. And again, you do have a recession, maybe it accelerates a little bit further. So when we're thinking 2, 3, 4 years out, don't expect a lot of good cash flow. If you are thinking kind of 10 plus years out, not a bad time to kind of buy it. We never know what's going to happen in 5 to 10 years, but we do know the margin of safety on office properties looks a lot better now than it did 3, 4 years ago.
Yeah, absolutely. I mean, at least the nice thing about the tangible asset space is that unlike things like VC or private credit, you still have an asset at the end of the day. Whether it's underutilized or it's not generating enough cash flow, you are always going to have something that you can offload or leverage or do something with to reposition that within your portfolio. But again, just looking at the office space is just, again, I really appreciate the insight on it because, again, to the point of everyone that I've talked to has just been like, I say office and they're like, all of a sudden they go deaf. Just kind of one of those things where they don't want to look at it.
That puts a smile on our face. I mean, we do say we'll be within consensus at times, especially given the long duration of our assets. But when we're out of consensus, it makes us a little bit more, a little bit happier. Just to kind of punctuate your point there, when we look at fundraising, particularly in core real estate, and office is very much a core asset. There are a lot of institutions that put a lot of money over the past 10 to 15 years, especially because fixed income wasn't giving you a lot. So core office properties is typically good fixed income replacement with an inflation edge. We haven't seen this drop in fundraising in over a decade. Like, it's just plummeted off a cliff. No one's putting money in there. That usually gets us a bit more excited.
Yeah, exactly. But then you also kind of mentioned, and this was kind of something as well, I kind of skipped it in my notes a little bit, but looking at the default cycles across the board on any type of of capital deployment, that would seem to me to be a concern. But you're saying that you're not necessarily seeing the default cycles rise as much as I think they would be or are kind of poised to be. Could you maybe elaborate a little bit on that too?
So they are rising, but with CRE, it doesn't happen in, Powell said this yesterday in his testimony, it's more of an elongated issue. It doesn't happen overnight. Deals come in, transactions come in over time. So we are seeing that rise. The distress, particularly in the U.S., is now exceeded the COVID levels, I think going back a couple quarters ago. So it is rising, but it's not near the GFC levels by any means yet. Will it kind of rival that? Yeah, it could definitely rival that. We're not saying that GFC came about for different reasons. The commercial real estate situation is coming from different reasons, more fundamental to kind of office. But we are seeing the stress rise, and we continue to expect that. But when we're looking at private assets, thinking about how to enter them, whether that's fund managers or direct, and thinking more longer term, 5+ years out, we want to start kind of being in that position to put capital to work and get that into fund managers and have them kind of buy these assets in the near term.
Yeah, and would you say that these are, at least from the And maybe kind of looking at it because you also mentioned, private hedge funds and the private credit space. Are you seeing any of these people kind of come back into the space and start adding these, maybe, started adding this as part of their portfolio of investments, or is it kind of just, the one-off operators or the GPLP kind of structure that is still kind of ruling the commercial real estate space right now? Or are you starting to see some bleed in with people wanting to get a piece of that pie because of the significant discounts and, the inherent protections that are kind of built in when you buy so cheap?
Well, if you were, I guess to answer your question, if I'm interpreting correctly, if you're in a good position, I don't want to name names or asset managers, but if you were in a pretty strong position that you weren't taking big hits on some of your property, you weren't too deep into the office space, I mean, you could see the amount of capital that's going. It was just one of the best risk-adjusted returns for a very long period. So a lot of capital drew in there. But if you weren't in that kind of position where you're getting dinged, and Blackstone's kind of one of them, you do have the ability to put capital to work and take advantage of these distressed opportunities. So operators, so asset managers and operators that are at a good point of strength are in a good point to negotiate and take advantage of the stress opportunity set. Similarly, those folks that are in lending strategies, especially distressed debt, which really hasn't had a distressed cycle really since the GFC 2020 came and went. Those folks are in a good spot to be lending capital now. Knowledge of the real estate space, you need to have a bit more knowledge of that space versus maybe lending to the cash flows of software companies, healthcare companies, et cetera. That's typically it's more common in direct lending. But those folks that can get that expertise within real estate distress, particularly those distressed lending strategies that haven't had a good opportunity set for a very long time, they're also in a spot to be lending capital. We are seeing a number of them, and they are in the kind of private credit form, but they're also hedge funds too. Hedge funds that typically do evergreen structures, but also have the ability to do more drawdown, long locked up structures that can go in the private space and have very deep knowledge of working with from a distressed standpoint, but moving out the real estate side that can incorporate those resources. They're also in a very strong spot to be taking advantage of these opportunities, and we're seeing that as well.
Yeah, and you brought up a good point too. It's the buzzwords are always kind of interesting, but you see the the precipitous rise of just like how many people are talking about private credit, and it's interesting that you draw that correlation of saying, look, the distressed debt people, really again they haven't they haven't had much coming to their table in the past 10 years, which is, I mean, good or bad. It's if that's kind of where you really understand the market, that's where you can make the most money. You haven't had much deal flow lately. But, as the economy as a whole, maybe it's good that there's not a ton of distressed debt out there. But the fact that it's kind of maybe taking a transition and into more of the private credit space, again, I find that kind of interesting. Now, would you say that what we were kind of, I mean, as far as the private credit space goes, it's again, the past 2 years, I probably have had maybe, you know, three or four people come to me and wanted to do some type of private credit investment with some type of operator or provider that does that and wanted to plug in some capital there. And maybe in the past, call it from like February to now, it has been probably a weekly occurrence of people coming across my desk that are bringing, different places that they want to deploy capital into private credit. What would you say is kind of the main driver? Is that, is it maybe the increase in the distressed, lending markets? Is it the, restriction of capital from the perception of it being expensive, or just not as much coming out of the institutional side of things? But that's kind of where I maybe want to end it, because I think that's kind of the big additional factor to this, is the rise in the private credit space as it relates to CRE and what we've been talking about.
Yeah, so maybe focusing on private credit and the rise in private credit is often most synonymous with senior direct lending, and we carve out like the stress from that opportunity set, and we do cover that within private credit, which we always tell investors, and that includes public. But when you do think about private credit, and I'll say senior direct lending, two main reasons of why it's increased over the past few years is one, well, rates are higher, so you get better yield out of it. You're seeing double-digit yields, et cetera, et cetera. We don't model it at. You will have defaults, recoveries. You're not going to get paid that full coupon, but you will get a pretty healthy high single digit, maybe low double digit, even after leverage. So that's extremely attractive. And then you think about the liability driven investors like insurance and pension funds, and that's where a lot of that capital has come from. They salivate for that. Lock in liability hedge, you lock in you're matching your assets to liabilities. If you have a nominal policy rate of 6, 7, maybe even 8%, which a lot of them do, well, you're exceeding that when you're getting into these private credit funds. And the risk is that they get all that capital off, which is another discussion. But just the simple rise in interest rates have gotten a lot of these institutions extremely interested in the space. Although that was, happening before, but it really accelerated recently. The second reason, which is actually a fairly dangerous reason, is because of and I hate when asset managers, I dislike when asset managers state this, especially when, being someone that sat in those rooms and had them come in, do an hour meeting, is the default rates. Okay, well, this is almost risk-free like lending. That is a borderline ridiculous comment to say it's risk-free. The reason they point to that is because if you go back to the GFC, the amount of defaults were very, very limited. I think a lot of folks quote less than 1% if you're senior secured in the capital stack. Well, senior direct lending was a fraction of the size back then that it is today. So it's a much different world, much more competitive world. It hasn't really been well tested through recessions. COVID is definitely an exception to this because it came and went very quickly. Everything was kind of covered up with the amount of fiscal stimulus that went out. So folks think it is more of a risk-free type of yield, and we always warn investors that no, this is not. But that's the second reason a lot of folks are excited about it, is because you get a very good high interest rate, high yield. But when you look through history, defaults have been very low. But we're very cautious on that. We do model a lot higher default rates, and a lot of these managers come into folks' offices and say they are modeling to.
Yeah, exactly. And to that point, I think that's a good place to leave off, because if people say something that's almost too good to be true, it is. I mean, look back to 5, 6, 7, and 8 with MBSs with AAA, tranches stuff within them. It's like, oh, these will never default. They'll never default. Oh, I mean, watch The Big Short. I think it makes it relatively palatable for people to understand what exactly went on. But it's a fascinating case study of thinking that, this stuff is so safe that it's almost, foolproof. Well, that I'll leave it there. But again, I do really appreciate your time today. It's always a pleasure to get to talk to someone that is, passionate and extremely knowledgeable, because when you marry those two things together, you have, quite the success. And I think we definitely generated some great content here today. So if there's any closing thoughts that you have, or some things that you want people to kind of maybe take a few salient points away from this on, looking at the CRE space, or, going forward into, what is going to be, whether it qualifies as a full recession or just, some type of more of a bear market coming up, what are some things that people should, kind of look at a high level that you really want them to take away from this?
Well, I think I stated it before, especially with our very positive view to stress. Most folks do not think there's going to be a recession. I was just on a trip a couple of weeks ago. I'm usually traveling once every month or two to various regions across the world. And on this last trip, I was paused numerous times in meetings to say, wait, you think there's going to be a recession? And as some of our strategists at BCA have highlighted before, really going back to 2022, we won't have a recession until people believe we won't have a recession. We're there. We're starting to see the labor markets crack. We're starting to see distress pick up. And we think that lends itself very well to opportunities going forward, which is why we're starting to get positive a lot of these long duration assets. But we will have some pain, at least near term, over the next couple quarters and maybe a year or two. Not a GFC-like event, maybe a bit shallower. But definitely going to open up some good opportunities for folks to get on these assets again. So very excited about the investment backdrop. I've been in my seat, or excuse me, I've been investing one form or another for a couple decades now. I can't imagine a better time to be an investor with interest rates where they are, potential recession coming up, and the opportunities that could come out of that.
Yeah, when there's blood in the street, buy property, right?
Yeah.
Alrighty, sir. Well, I do really appreciate it. We, as corny as it sounds, I always like to end these off the same way. The most valuable asset we all have is our time, because no matter how well we identify the markets, can't make any more of it. So appreciate you just taking a few minutes out of your day to talk to our listeners. It's been quite the engaging conversation. So with that said, I want to thank everyone for joining with us today. My name, as always, is Alex Perny. This has been the Alternative Investing Advantage podcast, and we thank you for joining.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.